Welcome to the finale of our Christmas countdown series, focusing on the S&P and Nasdaq. Probabilistic rather than deterministic is our preferred approach to the future, focusing on markers rather than anchors. This Christmas countdown series will have done its job if it's helped you debate the consensus and ask where the surprises might lie. Over the last 13 days, we've discussed a global economy that's dodged a recession but now faces slower, uneven growth, interest rates that may be cut more for the wrong reasons, and bond markets that look too calm. A softer but still powerful dollar, gold behaving like a crowded alternative currency, China as a volatile satellite, and India as a quality diversifier, while Europe and the UK are stock picker markets. While growth plus offense, that is the AI ecosystem, dominates the US market, North Asia is a leveraged AI play. Yet, financials are a possible dark horse and small caps a call option on a softer landing. And all of that brings us to the S&P 500 and the Nasdaq sitting at the crossroads of every theme we've just touched on. They are the AI trade. They embed the US macro story, the dollar, and the rate path. The leaders in these indices are not fantasy stocks. They're real businesses with earnings, cash flow, and global reach. This is not a dot-com rerun where nobody makes money. But there are two big focus areas. The first is concentration and expectations. A small group of mega caps has for some time carried these indices and perhaps an even larger share of the narrative. Valuations assume that AI delivers and margins hold. And that can be right for a while. But there isn't room for any disappointment. And the second is inflation. Current expectations assume continued growth strength and accommodative central banks. Any meaningful challenge to that premise is a problem for the whole market. For now, most bears have retreated, and with the S&P near all-time highs and the Nasdaq not too far behind, markets are trading very much in sync with the bullish narrative. However, the Nasdaq appears to have lost some of its earlier mojo compared to the more broad-based S&P. Our stance: stay bullish but watch three metrics: tech leadership, earnings growth, and inflation. Any damage to either of these will be a real threat to the broader market. Dispersion rather than index hugging and volatility rather than smooth secular trends are likely to be the dominant themes in 2026. We wish you happy holidays and will return in the new year with a new cadence and a new series. Happy New Year in advance. This is Sunil Garg from Keen Eye and Lighthouse Cantor.